Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following #QC Weekly Comment on LinkedIn. I'm your host, Gemma Woodward, Head of Responsible Investment based out of our London office. And this week, I'm pleased to be joined by Richard Carter, our Head of Fixed Interest Research, and Samir Shah, Senior Fund Research Analyst. Good morning to you both. So if I start with you, Richard, we've obviously seen America enter the fray with its bombing of Iran's nuclear facilities and mixed messaging about whether this is about regime change or not. So far, we haven't seen a huge spike in the oil price, but what are the implications for markets?
Yeah, it's interesting, actually. Markets have reacted fairly sanguinely so far, which I must say is reassuring, but also a bit of a surprise. I mean, I think the impact for markets will very much now depend, Gemma, on how the Iranians respond. Clearly they're making noises that they are going to respond in some way. So I think sort of Trump's kind of idea that they should sort of bomb them and then return straight away to the peace negotiations seems to be a little bit fanciful. There clearly is going to be some sort of Iranian response, and markets will respond accordingly. If they, which I think is most likely, sort of go after sort of US bases in places like Iraq, maybe using some of their proxy supporters, markets can probably live with that. The sort of nuclear option, as we know, is that they do something around the Straits of Hormuz, where a lot of the world's oil transits through. If they will decide to maybe place mines there or attack shipping, that would probably send the oil price skyrocketing and lead to higher inflation, obviously, but potentially also bring a recession into possibility. We'll see what they do. I think, interestingly, with obviously the Straits of Hormuz thing, that if they did try and close that would probably upset the Chinese even more so than the Americans. And I think the Iranians probably want to keep the Chinese on side at the moment. So perhaps their retaliation will be restricted to US bases in the region. So it's a very worrying situation, but as I say, market's fairly sanguine for now.
Thanks. And I guess, closer to home, we've seen interest rates remaining unchanged. The Bank of England kind of indicated that it felt the not so great employment numbers would imply lower pay growth, which then feeds into lower inflation numbers. Richard, what's your take on that?
Yeah, I think it's interesting, Bank of England at the moment. There's clearly some worry about the jobs market and about the pace of growth in the UK. Latest numbers weren't brilliant. Retail sales figures weren't good. There is some doubts over the labour market. Yet they didn't cut rates at the last meeting. I think they're still concerned about inflation. They're still concerned about sticky price pressures. We're seeing a little bit of a spike in CPI at the moment. But as long as that is fairly short-lived, they should be in a position to cut rates, if not in August, then maybe at the meeting afterwards. So the UK, the Bank of England still has more rate cuts to come, but as I say, they're just being a little bit cautious around the whole issue with inflation. Clearly, if we were to see a big spike in the oil price because of any Iranian action, then that would push back the scope, rate cuts even further. But I think all things being equal, we've got more rate cuts coming in a not too distant future.
Thanks. And that brings us on to Samir with his focus on UK equity funds. Now, I've got a few questions for you, Samir, and I've kind of blocked them together, so I hope that's helpful. So I was interested in your take on the government's growth agenda and how that translates into investment opportunities in the UK. As we know, the Mansion House Accord, signatories are committed, with some caveats to be fair, to allocating at least 10% of, defined contribution funds for pensions into private markets by 2030. And more significantly in that, at least 5% of the total going to UK private markets. I mean, this is obviously assuming a kind of sufficient supply of investable assets for providers. So we've got that happening in private markets. And at the same time, we've seen UK listed markets outperforming the all world index pretty significantly year to date. But the UK market is still seen to perhaps not be that attractive. We've seen one large pension investment manager, according to media reports, last week cutting its UK allocation by, around 75%. So what's your kind of take on the UK market, both private and public, at this point in time?
Thanks, Gemma. And those are very interesting and relevant questions to look at when assessing the UK equity market. I think it's worth providing a little backdrop on where markets have been, certainly over the past decade or so. The market has been faced with a series of major headwinds, including Brexit, COVID, the 2020 mini budget's effect on rates, and the inflationary impact of the war in Ukraine. Not to mention a strain on the UK's fiscal position with associated tax rises. Now, as such, UK equities, to my mind, have been overshadowed for several years as US exceptionalism has captivated investor attention. And actually, even more concerning is that the opportunity cost of missing out on a high level of international exposure has been very high. Now, this explains why so many institutions, including the major pension provider you alluded to, lowering their overall exposure to the UK through time, noting that it's gone from typically around 20 to 30%, let's say 20 years ago, to now low single digits for many providers. Now, as with the investment market in general, it is important to put things into perspective. And this is where I believe the UK equity market to be trading at a significant discount to its fair value and well below its historical average. Moreover, the UK equity market, which currently trades around the 12 times a one-year forward PE multiple, is pricing in really weak growth. And I think the UK economy is actually in a better position. And certainly the two measures that you referred to should help. Now, you're saying quite rightly that the Mansion House Accord indicates a willingness of various pension providers to support the market. The trouble is that its focus is predominantly on private markets as opposed to listed markets. And this is where I think the wider opportunity set comes in, because I still have concerns about the level of supply at the private markets end of the market cap spectrum. Now, having said that, we are hoping that this will estimate a rough £25 billion inflow funneling into UK assets, which is great. And hopefully, as you say, half of those at the very least will come into UK dedicated assets. Additionally, you mentioned the government's growth agenda. And really here, the government is trying to kickstart the economy via investments in infrastructure, defence, the NHS, and greater tie-ups with businesses, which I think are necessary initiatives if we are to help revive the market. Now, that's on the good news, and this is all very promising. But on the downside, or certainly something investors are cautious of, is that if the government does not succeed, then investors will continue to ignore the market. And this is where I think we have to be cognizant of the dangers. The other implication of that is that other investors will become much more active in acquiring UK companies, with both corporate and PE buyers swallowing up more and more companies since 2020, with no signs of slowing down. Particularly those companies that exhibit market-leading positions, high margins, and a greater certainty of cash flow. The other consequence of exactly the initiatives you said is that if companies continue to be valued cheaply, the companies themselves will take action. And we are seeing that with aggressive buybacks coming through, signaling strong board confidence in the underlying operations not being reflected in valuations. And lastly, Gemma, just to highlight that the UK market cannot be seen as just one block. We've got the large cap side, which has got particular characteristics, and the rest of the market. And what we're seeing is that the large cap is currently trading at all-time highs, in part due to a large percentage of their overseas earnings coming through with a weaker dollar, and its defensive makeup with banks, energy, and consumer goods, which tend to hold up well during times of uncertainty. So I really do hope that the SMID-cap sector, which looks incredibly attractive valued, will be kickstarted with the catalyst of this, the Mansion House Accord and the government agenda.
Thanks, Samir. That's really helpful. And indeed, thank you both for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners. So please review the show now, wherever you're listening, and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We will be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. Thanks very much.